So welcome to webinar number 6. This is Mel, the scientific trader. Today we're going to be talking about trading analytics, one of my favorite subjects. Hope you've been following on. I'm quite amazed actually that I've got to webinar number 6. I started these webinars, I believe it was at the beginning of May. And these webinars are really just a journey, a diary of the journey that I've taken, and some of the key concepts which have really been important for me in terms of being able to make progress as a trader within the sports arena. This particular webinar is going to be the penultimate one. The very last one will actually be at the end of July, because the end of July will actually be the completion of the Scientia project, which began in middle of March. And by the last webinar, what we'll be doing is looking back over the course of the previous 3 or 4 months or so to really assess the development of the equity curve and whether this is something that is sustainable over the long term. So that will be, and then after webinar number 7 has taken place, once we move into August, I will sort of no longer be doing any more webinars or uploading my results publicly. I believe once we reach August, I'll sort of enter a nomadic state where I'll simply just concentrate on doing what I do best in private, and making as much money as I can with a type of career which is a beautiful career to have once you have something that actually works and can be backed by some very solid mathematical principles. So before we move into trading analytics, I think one of the things I just wanted to do was just, obviously a lot of us have been watching the World Cup in Russia, and I have to say it's been one of the best World Cups I've ever experienced. Now, I've been watching World Cups since 1982. The very first World Cup for me in 1982 was the very first team I actually saw play was Brazil. It was actually a game between Brazil and Scotland, where Scotland had taken a lead, and from there I saw the emergence of what I call perfect or beautiful football. Back then you had players like Socrates, Zico, Adair, Junior, Falcao, and that Brazilian squad actually 4 years later in 1986 in Mexico, I mean, much of that squad was still there, even though they were slightly older. But then it had been joined by the likes of Careca, Muller, Josimar, Edino. So I've been following Brazil, and I've got Latin roots in me, and I've always been following Brazil through the years, and was very disappointed with this World Cup. Disappointed on the basis I believe Brazil shot themselves in their foot themselves, because during the group matches I had sensed that there was not really the cohesion in the attack that I had expected, especially considering I'd watched a lot of the South American qualifying, and Brazil had really taken the South American qualifying to town. I mean, they scored the most goals. They were way ahead on points, and what had happened was the squad that you saw Tite use, especially using Willian on the right, and then using Coutinho and Neymar and Gabriel Jesus, that was basically the nucleus of the attack, which actually got them to the World Cup in Russia. So I could certainly understand that Tite wanted to keep that stability and keep the same format, the same shape. But I believe what Tite forgot. I mean, Tite is an incredible coach. If you've seen what he did at Corinthians, it was an incredible. So his choice as Brazilian coach to me was just a no-brainer. But I think, and this is what a lot of journalists in Brazil are thinking, they believe that Tite actually got it wrong on the basis that he was still trying to use a club mentality or a club strategy in tournament football. And in tournament football, there is a big difference, because if you're managing a club for a season in Brazil, then you've got over 30 games, 40 games to get things right. So you may use a particular partnership or a particular group of players, and even if they've performed in the past, even if they hit a bit of a downturn, you can still continue to use them, because you've still got lots of games for them to refine their form and for you to actually get the points you need. But in tournament football, you don't really have that luxury. And I think where Tite got it wrong was in the group stages. It was very evident that the combination of Jesus, Coutinho and Neymar and Willian wasn't really functioning. It was kind of spluttering. And we saw that in the game against Switzerland, where they scored, then Switzerland equalised, and then Brazil tried to turn it on, and it ended up 1-1. Costa Rica, they didn't score to the 90th minute, and scoring 2 goals kind of flattered them. Serbia, they played well in patches, but still it didn't look like a cohesive unit to me. And then against Mexico, again, I kind of felt that, they beat Mexico, but I just sensed there was something lacking. And when they actually went 2-0 down against Belgium, and it was half-time, and Tite was practically forced to make changes, where he brought on the dynamic Douglas Costa to replace Willian. He brought in Firmino, so rather than Gabriel Jesus being the spearhead, it was Firmino with Jesus out on the right. And then he brought on later, Renato Augusto. And if you watch the Brazil-Belgium match, it was really a tale of two halves, because Belgium were just incredible in that first half. I mean, it was just amazing football they were playing. But then in the second half, what you saw was the Brazil of old, where they literally battered Belgium. I mean, Belgium was still very dangerous. And to be truthful, Belgium still could have made it 3-0 on several occasions. But that was the price Brazil were taking to push to get that early goal as a platform to hopefully get the equaliser. But you would have seen that with Douglas Costa and Augusto and Firmino, how Brazil actually were just, that's how I thought they were going to be playing from day one. So I think Tite got it wrong. I mean, you're trying to pull a 2-goal deficit at half time. You get the 1 goal back in the 70th minute. You're really kind of giving yourself a lot of legwork to do against a side like Belgium. So I believe he should stay on. I believe Brazil, I mean, it wasn't the debacle of 4 years ago. I mean, Brazil went out trying, and I think you can't fault them for that. And there were some near misses and a couple of unlucky decisions. But and then England last night, and that's the reason why I delayed the webinar, because I was expecting to be talking about how a France-England final is really a tasty affair, and instead what I saw yesterday was the strength and mindset of the Croats, who I just thought were just absolutely amazing. It's funny, in the World Cup there's been quite a number of games where you've got a tale of two halves, because in the first half England were all over Croatia, and even though it was 1-0 at half time, I just felt that there was no way that England were going to let Croatia off the hook. And in the second half, because of some very shrewd strategical changes by the Croatian coach, all of a sudden it was Croatia that were taking the hot seat, and it was just really amazing how they managed to sustain the level of intensity, the level of aggression, to be able to pull the score back to 1-1, and then obviously win it in extra time. But I don't think this is any slight on England. I think England actually overachieved. I believe that they created a very, very good foundation for the future. And I think that they should come back to the UK with their heads held high. And I think they should have a tour bus ride, because I think that I think the whole country, even though there's going to be disappointments and various grumblings about what should or shouldn't have been in the match, I think ultimately England really did well. I mean, obviously you question some of the teams they played, but Colombia no mugs, Sweden are no mugs. Sweden, look how close they pushed Germany. They beat Mexico, and then Croatia, were taken into extra time. So I think overall it's a good tournament. I'm looking forward to Friday, and whilst my head would say France would be the favourites, I've been wrong so many times in this tournament. I've decided I'm not going to make any more predictions. So let's see what gives, eh? And but yeah, it's been a fantastic tournament. Okay, so moving on then, let's move into the presentation. So I'm going to start with June. June, oh dear me, dearie, June. Well, June, it was a it was a bit of a strange month. I'll tell you the reason why. As if you've been following me on Twitter, you would have known that at the end of May I was away for a week or so in Italy. I went to a family wedding, had a fantastic time in Florence, and when I came back to the UK, sort of the first week of June, the intention was to actually obviously start trading again, because I'd obviously missed a week, which was quite painful. And but what happened, there's been other sort of additional projects I'm running on the side, and one of them was a web development project which needed finalizing and completion by mid-June. So I decided just to throw my whole weight into helping some other people to get this website up and running. And if you know anything about coding with JavaScript and Java and dynamic HTML, it can be really challenging at times. And so I kind of sort of let my foot off the trading pedal, and then I did do some trading once that web project was over. But what happened was, it then coincided with the start of the World Cup, and being treated to 3 games a day, it was I suppose I underestimated how much watching games and getting caught up in games actually drained me. And so I just found that my my output for trading kind of went down, and I was still doing some trading, and then I was making mistakes, to cut a long story short, I think June was really just a break-even month. Just break even. I think I made some at the beginning, and then I went through a bit of a lull. I mean, if we look here, we can see the equity curve. And this equity curve, so you can see that the equity curve from March, when I started in March, there was a period of time, which I believe was around Easter, where it was a bit flat because I wasn't trading around Easter. And then it kind of went up through April and then through May. And then here, this plateau you can see here is for June. In fact, I think it slightly went down. So I was probably slightly in the negative for June. And then when it got to the end of June, I sort of said, well, okay, I've got 1 month left for the Scientia project. I've got to really just completely focus and give it my all. And so we can start to see some pickup here over the last week or so. It's first week of July, where I've, just completely dedicated myself again just to move in hell and earth to get some traction going, so that I can end the project with quite a big bang. It's also important to note that this axis here, the x-axis, is not showing you the number of trades. It's actually showing you the number of trading days. And it's important to get this fact correct, because certain people have been saying, well, my results I've only done 100 trades and I'm already talking about how good the model is. Well, I haven't done 100 trades. I've actually done close to 400 trades now. And that's 400 trades over 100 trading days. And bearing in mind as well that this whole project was based on backtesting from last year, where there were, I think, close to around 800 to 900 trades. So, we just need to bear that in mind. But as I've said, this is the equity curve as it stands. Unfortunately, June was a bit of... the other thing about June, which was quite interesting, I just wanted to mention, June wasn't as bad as I thought in terms of the number of matches that were available for me to trade. I had heard a lot of horror stories about June and the fact that with the World Cup on, it can really limit the availability of trading opportunities. And they were still there. I mean, obviously, I have to admit, it's obviously nowhere near as much as it was probably in May, April, February, or, August, September, October. But it was certainly strong enough to be able to put together some strong inputs. It was just obviously I didn't apply myself properly and kind of fell away, and then I kind of realized and just almost kind of just wrote June off and said I'll reset for the beginning of July. But June was okay. Now, part of me being able to see that June provided some good trading opportunities was partly because of the fact that if you're using sort of Bet365 to cover some of the opportunities that may not be on Betfair, but then Bet365 sort of comes in as a useful substitute. I mean, obviously the pricing is no way as good as Betfair, but if you have a reward to risk ratio that combined with the win rate means that you can still sustain some activity on Bet365, then it clearly allows you to still generate a large enough sample size to get some consistency in terms of your trades. So, June was a bit of a write-off, but there were other things at stake, and I just felt, come beginning of July, I would be re-energized, which I am now. So, just to give you an update on the equity curve and the reason for this plateau. So, before I talk about the analytics, because with the analytics, what I'm going to be doing is actually giving you an insight into 4 or 5 databases or services that I was using or looking into in June. Because in June, even though my trading wasn't that great, and I was kind of, my attention span was taken up with other things, I did still use June to look at ways that I could actually enhance my edge. Because I think when we had hit the beginning of June, my win rate was 50%. My win rate was 50% with a reward to risk ratio of around 1.6 to 1. And I still believe that there was scope to sharpen my edge even more, and possibly get that win rate up to around 55 and even 60%. And believe you me, if you have a strategy which is 50% with 1.6 to 1 reward to risk ratio, and you've got a strategy which has a win rate of 60% with 1.6 to 1, there is a significant difference in terms of the activity of the trading results and what you see in terms of the equity curve and the profit potential. So, but before I go into that, I just wanted to kind of re-emphasize some of the fundamentals that I follow, because I have received some communication from some people that simply just don't watch any of the previous webinars and then jump to conclusions when they're looking at webinar 5 or webinar 6, and or people that are asking questions which I've already answered countless times in the webinars. So I thought what I will do, just for the sake of people that have joined the community late on and haven't had time to look at the previous webinars, I thought what I would do is just re-emphasize 7 key fundamentals that I follow. And then for each of these fundamentals, if you actually want to look at them in more detail, then I suggest you go to some of the previous webinars where I actually go into them in a lot more detail. I'm not going to go into them at any great length now because it will be too much repetition. We've already done that in the first 5 webinars. So point number 1, or fundamental number 1, is I'm a big believer in financial market fundamentals. So looking at things like R multiples, risk of ruin, Sharpe ratio, Sortino ratio, expectancy and expectation. Now, just for some of you, again, that if you don't know some of my history, before I got into sort of sports trading, I had a big interest in terms of financial trading. I wasn't any good at financial trading. I want to emphasize that I didn't come from financial trader as a successful financial trader. But what I did do, I did start to grasp and understand some of the theoretical concepts which many of the world's leading financial traders seem to be basing a lot of their fundamentals on. And so in financial trading, things like R multiples is in reference to the whole issue of risk reward. And the R multiple concept is something which was very much profoundly promoted by Dr. Van Tharp, who was actually one of the traders that was interviewed in a book which was published many years ago. And the name escapes me right now, but if you go to, I think it was seminar, if you go to webinar number 1, you'll see more details about Dr. Van Tharp. Risk of ruin. I mean, risk of ruin is a concept that can be applied to sports, speculated on sports as well. But you don't really hear many people talk about risk of ruin. I mean, if any of you have bought any football trading packages, do they talk about risk of ruin? I doubt very much. But risk of ruin is a very important concept because unless you actually know what the average win rate is for the system that you're using, and also what the risk to reward is, then how do you know whether you're at risk of ruin? And Sharpe ratio, Sortino ratio, these are actually mathematical formulas which help you to actually understand the robustness and effectiveness of your strategy. Sharpe ratio actually sort of takes into account it kind of takes into account if you've got a strategy which is showing strong standard deviations in terms of in terms of negative standard deviations, then the Sharpe ratio takes into account the measure of your standard deviations of your trading results and the mean and various other aspects, whereas the Sortino actually is more balanced because it takes into account both ends of the standard deviation curve. So whether you're talking about 2-3 standard deviations to the left or 2-3 standard deviations to the mean, and so Sortino is actually seen more as a more balanced measure of the robustness because it's not just measuring things based on negative volatility, but I think it's also measuring things based on positive volatility as well. Then you've got like expectancy and expectation. We're going to look at these in more detail, but these are some of the things. Now, some of these things obviously can apply to trading in sports as well, but you just don't hear anybody talking about it. I mean, you just don't. And, it kind of, I just find it quite bizarre. So what I've tried to do is take principles from financial market trading and apply it to what I'm doing in sports trading. So as I said, I'm a big believer in risk to reward ratios. So I normally only get involved in trades where I'm risking 1 to make at least 1.5. sometimes I have to take 1-to-1 for reasons which I've already explained in previous webinars, but I try to take sort of 1.5-to-1, 1.6-to-1. Sometimes my reward to risk, this should actually be reward to risk. So I'm risking 1 to make 1.5. I've got risk to reward, which makes it seem like I'm risking 1.5 to make 1. I assure you that's not what I mean. Sometimes I may take 2-to-1, 3-to-1, or 4-to-1, or even 5-to-1, and it just depends, because obviously, as I've sort of talked about, the way that I actually do my trade selections and enter the market is based on not just what I've analysed in terms of pre-game stats, but also in terms of what I'm looking at in terms of momentum. And there was a prime example yesterday where there was a match in the MLS where the momentum drivers that I'm looking for were met, I think, with about sort of 3 minutes to go. So I actually got in when price was sort of around 1.2, and I lay. Most of the time I lay. So I lay as price is coming down to 1. Normally I get in around sort of 1.6, but in certain cases like yesterday, I got in when price was 1.2, and I could have taken a much bigger trade. So if normally my liability is normally sort of around £100, I should have actually gone in with a £500 stake. But I actually went in with 100. I was so shattered, tired at 2-3 o'clock in the morning. I actually went in with a £100 stake instead of £500, and then I was sort of cursing when the goal came in and I won the trade. And I'm cursing, even though I won £100, I'm still cursing because I realised I could have actually made a lot more. But so I'm a big believer in reward to risk, and the reason why is because I think if you start to aim for high win rate type systems, or sort of like a high win rate, then you start to enter the realm of where possibly you're starting to sort of adopt a methodology where you're taking small wins and getting clobbered by big losses. And I've seen it many times, especially when it comes to drip playing, where people will drip play for a goal to come around 60 minutes, and they'll drip play. And ultimately, if a goal doesn't come by the end of the match, they've got a big loss. But if they drip play, if the goal comes in the 60th or 70th minute, it's boom, 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 booms, boom, boom. But booms mean nothing, because if you've got 3 goals that have come in, 1 in 60, 1 in 70, 1 in 80 minutes, well, the combined total of what you've just earned in profit, how does that compare to what happens when you get the loss? And so, to me, really jumping up and down because you're getting lots of small wins, it's just not something that resonates with me. For me, I need to be earning at least 150% of my initial stake, or I just can't. I just don't have the mindset of being able to accept small wins, when in the back of my mind I'm worried about the fact that a big loss can actually wipe out 2 to 3 of the small wins. And this is one of the reasons why you'll find that people who adopt systems with high win rates, you'll find it's very difficult for them to scale up, because when you start to scale up, you become a lot more sensitive to how big the liability is going to be if the trade doesn't go your way. And so, for instance, if you're risking 3 to make 1, even if you're risking 2 to make 1, if you're risking £100 to make £50, it might not be too much of a big deal from a mental perspective. But imagine risking £1,000 to make £500, or risking £10,000 to make £5,000. What you find is that as you start to scale up, obviously that differential is actually going to start becoming an issue. So I'm a believer in probability theorem, and I can't even spell probability, but I'm a big believer in probability theorem. And so I fully believe in order to save yourself the heartache of having a system which behaves in a way which you didn't expect. It's very important to understand what probability theorem is all about, because that sets the basis for understanding the whole issue of winning streaks, losing streaks, natural random distribution of results, understanding standard deviation moves, understanding means, medians, and really just having an insight into probability theorem, which helps you to prepare for when you do get losing streaks, winning streaks, or trying to understand why on earth did you get such a fantastic run of results, and then all of a sudden, the next set of results are just bizarrely gone south. And so with probability theorem, that brings in other things like mean reversion and understanding that there is a balance that takes place, and you can't just have an equity curve that is just constantly going up, or an equity curve that's constantly going down. If you have a positive expectancy, that it's like a rubber band, there's pullbacks, there's growth, pullbacks, consolidations. So that's why, for me, visually, the equity curve is so important in terms of understanding the flow of an equity curve. I'm a big believer in Monte Carlo analysis for reasons I've explained in previous webinars. Monte Carlo analysis is a tool that's used by a lot of financial traders, especially technical traders, who are looking for insights into possibly and looking into how they can actually simulate large sample sizes of strategies that help them to understand potentially how a system may perform in the future. So Monte Carlo analysis is really just generating random results based on the strategy parameters that you've put in terms of win rate, in terms of your risk to reward, any sort of potential cost involved. And for me, it's been a great component to have in my arsenal. Not everybody goes for it, and that's fine, not a problem at all. But for me, Monte Carlo is one of the reasons why I've got so much confidence in what I do, so that even when I hit those barren periods, I kind of brush it off and it doesn't play on my mind as it used to many years ago, because I'm realizing that the strength of survival in this industry is having a long-term perspective. I'm a big believer in pre-game stats, and the reason for this is because of the fact that it helps me to narrow down or provide a much narrower range of possible trading opportunities, and it allows me to then focus. And pre-game stats, I mean, if you actually look at some of the very successful sports hedge funds out there, like Stratagem and Primer from Australia, they will tell you the same thing, that pre-game stats is a very big aspect of how they do their modelling, their data modelling, and their data visualizations. They don't just go and base it on match odds or price or what's happening. It's a combination of pre-game stats. And pre-game stats is important because at the end of the day, stats don't lie. And even though football is quite a bizarre game in the sense that you can have two teams who've scored plenty of goals, have poor defences, have great attacks, and then they come together and it ends up 0-0. So you can never get away from odd things in football and a streak of odd things. I mean, I think one of the things, was it last week? I was doing some trades in the Icelandic, there's no secret that the Icelandic leagues have a high potential for goals, especially late goals. Yet last week, I think out of 6 or 7 games in one day, not one of, all but one, had a late goal. So one of them had a late goal, and all the other 6, there were no goals after 65 minutes. It was just, or 70. It was just bizarre. It was absolutely bizarre. But those things can happen. Those things can happen, and so we're not saying that pre-game stats is sort of like the be all and end all of data analysis, but it's certainly a good component to have. I'm also a big believer in technical momentum analysis as well. Momentum is quite subjective. I showed in my last webinar how I use momentum, and it's just a very sort of it's a sort of my own style, my own way of doing things. But there's other modes of momentum analysis. I know some people use in-play sort of in-play information from Bet365 or in-play scanners, where it kind of gives you an insight into pressure, how much pressure has been applied by one side over the other, and shots on goal and corners. So momentum, I think momentum is quite subjective, and I think it's just one of those things where you have to really devise your own method of momentum which works for you. Because the way that I do momentum, where I'm reading charts like technical, like a chartist would in technical trading, in financial trading, that's not something that most people probably would do. And I wouldn't really get involved in terms of basing things on numbers of shots taken or whatever, because again, that hasn't worked for me in the past, but then it works for other people. So some of these decisions you make are going to be subjective and based on what works for you, and that's the beauty of trading. And that's why when people are saying that the system they have is the be all or end all, you just have to sort of turn a blind eye to it, because what they're basically saying is that trading is so limited that there's only one or two ways that you can ever make money. And the fact is that there's so many different ways that one can trade. There's so many different ways that one can actually make an assessment of whether one should take a trade or not. So for instance, I could be looking at a game, you could be looking at a game, and I get a justification to go in and place a trade on late goal, but you don't. Yet we could still both be profitable over the course of the month and years. So it's really important for me to drive this into people's heads. And if it doesn't sink in, I have to come to the conclusion that you're either you're either dangerously stupid or willfully ignorant, because trading, there are so many variables involved, there are so many interpretations of variables, there's so many different subjective ways of reasoning, that how on earth can you just base and that creates a complex, we call it a complex tree map of interconnecting points of different possibilities and endless and the truth is that there's infinite possibilities. And so it's possible that I could have a particular pathway that works and you have a particular pathway that works, yet we are basing it on different variables or using the same variables, coming to different conclusions, yet still be profitable overall. So that's why I try to be very humble in my approach. So if I have something that works for me, it doesn't mean that it's the only thing that works. I know people that do things very different to me and are actually earning a heck of a lot more than me. So what am I going to say about them? Am I going to say that they're an outlier, or that it's pure luck? Yeah, pure luck after 500, after 10, after 100 trades, 500, 1,000, 2,000 trades. There are people that are making money day in, day out, week in, week out, with systems that are completely different to mine. Who am I to say that they should follow mine and not theirs? So, and that's why I think at the beginning of these webinars, I always used to have this sort of disclaimer to say that all I'm doing is offering kind of like a smorgasbord approach, where I'm giving you like a platter full of different delicacies, and it's up to you to take what applies to you. You might take some of the delicacies and find it's absolutely distasteful, but then some of the others are absolutely exhilarating. So just be mindful of what I'm trying to do is not push what I'm doing as the be all or end all, but come in with an approach which I think some people gravitate to. And there are people out there that have actually said they really do resonate with what I'm talking about, because it's just not talked about a lot by other people, even though other people claim that what I'm talking about is nothing new. Yet when you actually look at what they talk about, the content is so vague and so flaky when it comes to the issue of probability theorem. I also believe in riding the wave and minimizing the fall, and this is really based on the battle plan approach. So I believe, and just based on my results, every day or every week, every single day of every week provides a different combination of results. So sometimes I'll start off with a couple of wins or a couple of losses, or it might be win, loss, win, loss. So what I'm saying is that every day in the week, most of the time provides like a unique arrangement of wins and losses. And so what that basically means is I'm able to create a system where if I start off with a very strong number of wins to kind of start my day off, then I can ride the wave and I can really kind of press home. And I think we talked about that in the past, where we talked about the premium hands. You get some days which are premium hands where nothing can go wrong. I mean, yesterday, was it yesterday? I think yesterday was an example, because there were some trades I missed yesterday. I mean, I didn't even bother talk about it, because there's no point telling you about trades I've missed and whatever, because to me, that's just part of life. And we're never going to have perfect days all the time where everything goes our way. But there was about three additional trades I missed yesterday, which were all wins. So I could have actually ended up with a day where I had 6 wins and 1 loss. And you get days like that where everything goes right. Every single, it's like going bowling and you throw that ball and you're just in the zone, and you just know from the time the ball leaves your hand, all of those skittles are going to be knocked over. And then you get days where it seems like everything is against you. And those are the days actually which can cause you to actually question your strategy. Because if you've got a strategy, if you get a day where your first 4 trades are losses, and especially if you're somebody that doesn't stop and you just continue trading because you're somebody that tries to use is more focused on using the law of large numbers, and so it's just about generating as much sample trades as you can, increasing that sample size. Can you imagine hitting 5, 6, 7, 8 losses in a row? Yeah. And so you get days like that where you kind of think my strategy is broken, because the mental effect of losing it far outweighs the exhilarating feeling of winning. And so when you get those days of losses, it really does play on your mind, and that's why you have to have certain types of sort of psychological structures in place to protect your emotional capital, so that you don't do something stupid in terms of trying to sort of get revenge back on the market, or deviate from your plan because you think it's broken. So these are the fundamentals that underpin what I do, and I've kind of listed them here because I think it's very important to that people that have kind of started listening in the later webinars and may have missed out on early stuff don't come to sort of silly conclusions because they just haven't listened to the journey from webinar 1 up to webinar 6. So those are the fundamentals of how I approach my system and my trading. Okay, one of the things that I wanted to talk about was, as I've said in point number 1, there's quite a few things there that I could talk about, like risk of ruin, Sharpe ratio, Sortino, expectancy, expectation. But one of the things that I wanted to sort of focus on was expectancy and expectation, because there is a difference between the two. And it's very important to know what they mean. And this is something that really helps me in terms of developing trading systems and being able to assess. And I think this will be very important for those of you who are looking at different trading systems and are trying to do some sort of comparator analysis to see which one is probably more effective than the other, especially where you might have 2 trading systems whereby they're kind of coming out on an even keel, yet they've got very different approaches. And expectation was a variable and a property which helped me to understand that there are still ways that you can differentiate between 2 systems which are actually neck by neck, but with two different approaches. So what I wanted to do first though was just go back to NetPicks. NetPicks is one of the they're one of the trading rooms that I follow and am involved in, because the things they talk about are just some of the best things I've heard. I mean, I was very good at statistics, and so what they talk about kind of resonates with me because they really go to town on it, and like other educational houses. So let's hear what NetPicks has to say. This video I'm going to play is about 9 minutes long, but I do advise you just to look through it because it's going to form, or it's going to underpin something which I'm going to sort of talk about after the video ends.
Now this is going to be quite the video about profit factor and trade plan expectancy, so you might also want to check out the blog post for this, and you can find that link here. And you're going to learn the minimum basic trading performance metrics that are required to really assess your back-tested trade plan, your trading system, and track your progress as you trade it. And as you're going to see, win rate's important, but there are other factors that are equally important, such as your system profit factor and the expectancy. So we're going to cover the following metrics and relationships between metrics, such as win rate, loss rate, average win, average loss, total number of trades, number of winning trades, and number of losing trades. And the last three are probably the least understood, yet could be called the most important. It's the profit factor, the statistical expectancy, which is average profitability per trade, and expectation, which is the mathematical outcome. So your win rate's usually the metric that's first considered by new traders, and it's often pitched by trading systems or service sellers in aggressive and really over-the-top advertising. The win rate's calculated by dividing the number of winning trades by total of number of all the trades, and it's often represented as a percentage. Now on the flip side, loss rate is simply the number of losing trades divided by total of number of all trades. And we often hear of systems that have high win rates, or even systems that never lose, of course, but in trading there are always trade-offs. And the most important metric to be linked with win rate is average win and your average loss. Now your average win is calculated by taking the sum of all your winning trades and dividing it by the number of winning trades, and it's the expected value of an average winning trade. The average loss, this is calculated by taking the sum of all losing trades and dividing by the number of losing trades, and it's the expected value of an average losing trade. And a system with a high win rate can still be a losing system if the average loss is much greater than the average win. And this important detail is often left out by promoters of high win rate trading systems. So for the purpose of the following example, I'll refer to the gains and the losses using dollars. However, gains and losses can be expressed in dollars, points, ticks, pips, or whatever unit of measurement you choose. This figure here shows an example of an equity curve resulting from 300 trades taken using a system with a high win rate of 90%, but with average losses that are 20 times greater than the average win. Now these types of systems can be seductive because the high win rate is alluring for a while and can often appear to be paying off, but then the inevitable losses occur, wiping out all the gains. An example of a strategy capable of this type of behavior would be an option spread selling strategy. The premiums collected are small and predictable, but when the market suddenly moves against you, the losses can be significant. Now notice that the first 15 or so trades were winners, but the next trade wiped out the gains and returned to break even. Also notice that there was a period starting around trade 205 that went for over 50 trades where results were positive, but again, the subsequent trades wiped out all the gains and then some. When the win-loss ratio is this unfavorable, even high winning rate, it's not enough to make up for the losses. And the stats associated with these types of systems, it makes them losers in the long run. This one here shows a trade plan with only a 10% win rate, but unlike the first trade plan, the average trade win is much higher than the average trade loss, 18-1, resulting in a winning trade plan. An example of a plan capable of this behavior is one where each trade risks a small amount of capital with the small expectation of hitting a home run. And there are lots of small losers, but when that trade is successful, the gain is huge. Now this example starts with a number of losing trades followed by a win that more than makes up for the losses. Now notice that the overall equity curve is positive, but there's a section in the middle where a string of over 50 trades is in a drawdown. And although these types of plans can be profitable, many traders find it difficult to handle the trade psychology, and the stress associated with long stretches of losing trades just causes them to abandon the plan. Now this one here shows a trade plan with a 50-50 win rate. Each trade is just as likely to be a winner as a loser, but since the average winner is twice as high as the average loser, the overall equity curve is positive. Now notice that there are periods of drawdown just like the second example, but they tend to be shorter in duration because the overall equity curve is smoother. Since the number of winners is approximately equal to the number of losers, we really don't have long periods of either winners or losers. So how do we determine whether or not a trade plan has the potential to be profitable? You seek out a profit factor calculation, and here's how to calculate profit factor: the ratio of the sum of all winning trades to the sum of all losing trades. Now, profit factor needs to be greater than 1.0 to have a winning plan. This makes sense. It simply means that you need more total winnings than the total losses. The second formula shows how profit factor can be calculated using the win rate, the loss rate, the average win amount, and the average loss amount. And it's easy to see now why the first trade plan was a loser. Now here's the profit factors for the second two trade plans. Trade plan 2 profit factor is 2. Trade plan 3 is 2. Now both of these trade plans had profit factors greater than 1 and therefore are profitable. Now all else being equal, the higher the profit factor, the more profitable the trade plan. And another important performance metric that makes use of the win rate, loss rate, average gain, and average loss is statistical trading expectancy. And this metric is calculated as follows. Now this metric is also known as the average profitability per trade because it gives us the expected profit on average for each trade made. And here is the expectancy for the 3 trade plans above. Now you can notice that on average, the first trade plan is expected to lose $1.10 per trade, another indication that it's a losing plan. After 300 trades, we can expect to lose on average about $330. And the chart shows this loss to be a little over 400. The next 2 trade plans have the same profit factors, so you might be inclined to conclude that they are equally profitable. But notice that the trade plan 3 has a greater expectancy per trade. After 300 trades, we would expect that trade plans 2 and 3 would have net gains of $270 and $750. The equity charts confirm this. Notice that, like trade plan 1, they are close to their expected values, but not exact because, again, we're dealing with statistical expectancy. And a final example of expectancy is shown here, which is a trade plan with a 60% win rate with an average win of 10 equal to the average loss of 10. Using the above formulas, the profit factor is 1.5, the expectancy is 2. Now, even though the average win equals the average loss, this trade plan is profitable because the win rate is greater than 50%. This shows that with an expectancy of $2 per trade, we can plot the expectancy along with the actual trades to verify that the plan continues to be valid. If we see that over time that the actual trade equity diverges from this line, then we know that the market has changed and we will need to reevaluate our plan. And this is useful because in order to analyze our trade plans, we need to include not only the win rate, the average wins and losses, and profit factor to determine that we have a winning plan, but we need to add expectancy and number of trades in order to determine exactly how profitable we expect the plan to be over time. Now, trading expectation. There is another stat that's useful for determining how robust a plan is. It's called expectation or mathematical outcome, and it's calculated as this. This metric reflects a more subtle concept, but it's an important one. Expectation reflects how robust a trading plan is by measuring how sensitive it is to change in average loss. The greater the ratio of expectancy to average loss, the higher the expectation. With high expectations, small changes in average loss will have little effect on our net profits. As this ratio gets smaller, however, small changes in average loss will have a greater impact on our net gains. So some good rules of thumb for expectation are, if the expectation is less than 0, then the expectancy must be less than 0. It's a losing plan, and that should not be traded. If the expectation is between 0 and 0.5, then the plan's okay, but we should monitor our losses to make sure the average does not significantly change. If the expectation is greater than 0.5, then we have a pretty robust trading plan. So using the formula above, expectation for our 4 example trade plans are right here. And it should be no surprise that the expectation for trade plan 1 is below 0 since it's a losing plan. Of the remaining 3 plans, trade plan 2 is the most robust with an expectancy of 0.9. Expectation for trade plan 3 is right at 0.5, which means it's moderately robust, but it should still be monitored. Finally, number 4 is the least robust, and although it's profitable, it should be monitored more closely for changes in conditions that might cause it to become a losing plan. There are also a number of other trade plan metrics that are useful for other purposes, such as fine-tuning your risk per trade, but the metrics presented here will at least ensure your plan has the potential to be profitable in the long run. So the next time someone asks you for one of the most useless trading stats, your win rate, give them other stats. For example, well, say that the last year you had 875 total trades, 350 losses with an average loss of $200, a profit factor of 2.25. See if anyone can determine your win rate and your net gain for the year. And the answer is 60% and $87,500.
So that video was about 9 minutes long, but hopefully it gives you a bit of an insight into things that I prioritize. And again, as I say, in sports trading, none of this is talked about, or very little of this is talked about actually. And for me, I have to wonder why. People talk about lots of things, but these things which have just been talked about, I think are excellent concepts for one to grasp if they really want to sort of understand the robustness and the efficiency of the trading system that they have. And in order to be able to conduct that, you have to know things like what your win rate is. You can't just have this kind of vague pie in the sky that, well, I don't know what the win rate is, because trading is, things are constantly in flux and changing. How on earth can you make any projections if you have a system whereby you can't even determine what the average win rate is? So that's now NetPicks. You may remember the very last property that was referenced was a property called expectation. And to me, this is actually one of the most important properties or variables which I've ever come across in helping me to understand the robustness of a system which I'm using, and really given me the confidence to know that if it meets a particular level of expectation, then I can be quite confident of the long-term, the long-term results. So if I go to the next slide, you're going to actually see this table here. Now, this table has an x-axis and a y-axis. On the x-axis, you've got 0 to 72. And this is actually a reference to the win rate of a system. Now, it hasn't gone past 72% because based on the types of trading that most people do in financial trading, the win rate will not normally exceed 70%. And on the y-axis, you also have the reward to risk ratio. So basically, the way that you kind of use this, essentially these results here are the values of expectation. And if you can remember in the presentation, he talked about if you've got an expectation which is 0.50 or above, then you've got a system which is quite robust, and sort of small changes in the average loss won't have dramatic negative effects in terms of profitability. But he said if it was below 0, so in a negative range, then obviously you've got serious issues. So as an example, I mean, what I'm trading right now with my system, it's trading based on the results up until the beginning of June, it was trading at around 50%, and my reward to risk, I think my reward to risk was around at the time was around 1.6. So as you can see, my expectation value at the beginning of June was around 0.30. And if you can remember in the video, they said that if it's between 0, if it's above 0, then it's good. But if it's below 0.5, you've got to just be mindful of how the strategy performs, especially when you hit downturns, because what you don't want is for your strategy to actually go into the red range. Yeah. So expectation is it's a very, very good it's a very, very good process in place to address the robustness of your system and its ability to recover from losing streaks and downturns. And there was an equation that they used to sort of uncover what your expectation value is, but you can also use this particular table here just by knowing what the two values are of your win rate, your average win rate and your average reward to risk ratio, can then help to determine. Now, what I'm trying to do, as I'll talk about a little bit later, I'm trying to sort of bring my trading system into the green range where it's above 0.5, and I think once it hits sort of a 0.5, 0.6, that's where I'm going to become a lot more confident in terms of moving forward and sizing up, because I know that I've actually hit this sort of green range, which is a range of stability, as opposed to being in a yellow range, which, while it's okay, you're still kind of slightly conscious of the fact that you could sort of go into the red range if things happen in your system which cause it to start to in terms of the results actually starting to sort of do a U-turn, and then all of a sudden you find that you've got a system which has actually gone down to zero or into the negative range. So this is expectation, and it's a fantastic, and in fact what I'm going to do, I'm going to play something else for you to listen to, which somebody else that explains it much better than I'm able to do.
And you will see this. What you're looking for is an expectation as close to the green or as far away from the red zone as possible. So you line up your average dollars won divided by your average dollars lost, 1.1 in this case, and you come all the way over to the right until you get to your winning percentage, which is along the top here. And that brings us to this number right here, 0.47. So we're just bordering the green zone. Anything over 0.5 will end up in the green zone. This is actually very good because there's a lot of wiggle room. If the system gets into any sort of trouble and drawdown, you're going to tick down a little bit. You're going to have to go down quite a bit before it gets into the red zone. And it won't take much to push it into the green zone. One good winning streak, for example. A lot of times I'm asked the question, well, how do you know when it's time to ditch a system? How do you know if the system is just going through a tough patch or if it's actually falling apart and will continue to lose money? One thing you can do is keep your eye on this expectation table, because as the system begins to degrade or the performance tends to go down, the expectancy will little by little start moving either closer to the red horizontally if the winning percentage drops, or vertically if your average dollars won versus your average dollars lost goes down. So those two pieces of information we're keeping an eye on here with this table, and as you get closer and closer to the red, well, the red flag should go up and warn you that perhaps it is time to start making a serious change with your trade system. So the expectation table is very, very important to your trading. You should always keep your eye on it.
Okay, so I hope you found, sorry about the video quality of the sound with the sounded like a sort of echo. I just wasn't able to do anything with it, but it was a short video, so it wasn't too much to cause too much of an issue. But expectation, so that I think is one of the examples of something which can really help you in terms of having an understanding as to whether the system that you're using is robust, whether it falls within the green range, whether it falls within the yellow range, or whether it falls within the red range. And it's tools like that, which exquisite tools, I would say, which are very, very useful and purposeful in helping you to get some sort of advantage in advance of knowing whether what you have is something which is sustainable in the long run, or whether there's needs to be some sort of tweaks to the system to get it to position where it enters a realm of stability. So I hope you found that sort of quite interesting. And again, these are some of the things which they taught me when I was in financial trading, which I've tried to sort of bring over to what I'm doing within sports trading. Okay, so as I've said, towards the end of May and certainly sort of the beginning of June, I embarked on a quest to see if there was any way I could actually sharpen my tools, my edge. A 50% win rate where my average win or my average profit is 1.6 times more than my loss is a good starting point. And I mean, obviously the equity curve is a demonstration of that, but I still kind of felt that there was some wiggle room, and that sort of became evident when I was doing some sort of deep-rooted data analysis to uncover that there was a clump of data which seemed to be weighing down my win rate more significantly, and that when I was able to remove that clump of data, that it really had a very, very positive effect in terms of bringing my sort of win rate sort of between 55 to 60%. Now, obviously, you know, there are dangerous grounds when you are doing optimization of data, because you don't want to get into the realm of curve fitting. So I had to make sure that the clump of data that I was looking at removing was had a high enough number of occurrences to be statistically meaningful. And I believe it was. And so what I've been doing is kind of looking at ways that in July I can really start to push forward, knowing that you know, if I've got a win rate which is approaching 60% based on late goals after 84 minutes, I mean, that is actually a significant system in place. I mean, you've already heard you know, the prophets of doom have talked about how my expectation should be more around 35-40% in terms of win rates. Can you imagine their reaction if I get it up to 60%? I mean, you'd never hear the last of it. But that's besides the point. It's no issue on me, because at the end of the day, it's the bank account that speaks volumes more than what somebody's opinion is. So what I wanted to do at this stage was just show you some of the databases which I've been using to help sharpen my edge. And some of them have been very useful, because there are certain types of data points that I'm looking for in order to help me have a good way of knowing, or having a good way of developing a system which gives me insights into whether late goals are going to happen. So the first organization, it's actually an organization which is actually going to cause you to laugh. It's actually one of the oldest institutions in Hong Kong. It's called the Hong Kong Jockey Club. They're basically a racehorse operator. I think they've been around since 1884, so there's a longevity, well-renowned, well-respected institution. But what's quite interesting, and this was actually information that was I was advised of from Rui in Portugal, who does a lot of data analysis on football stats and has a tremendous wealth of expertise. So Rui, if you are listening, thank you very much. Rui Trader, RUI, Rui Trader, you've provided this insight to me a couple of months ago, and I've been looking into it and been very impressed. One of the great things about this particular website, if you go to football and you go to, let me try and remember now, Stat Center. So if you go to Stat Center and you go to leagues, what's quite interesting, they actually provide a level of data that no other site has that I'm aware of, especially a site where you get the information free. So, for instance, if I go to the English League and I go to the Premiership, one of the things that they do, which is quite interesting, and certainly for myself as a late goal specialist, they actually provide stats on goal time distribution on a interval of I believe it's every 10 or every 5 minutes. Now, the English Premier League right now is not in existence because obviously the new season is about to start in August. So let me go to the Norwegian, because that's a league that's presently in flow. And if I go to goal time distribution, what you'll find is that it actually gives you the numbers of goals scored by each team within 5-minute intervals. So, you know, first to 5 minutes, and it goes all the way down to 81st to 85th minute, and then beyond 85 minutes. Now, this is great data because not many sites, I mean, I'm familiar with other sites like Soccerway and Soccer Point and Soccer Stats, and none of those stats give you this level of detail. So here we've got a website where they actually give you a breakdown of the goal distribution of each particular team in 5-minute intervals. So if you're somebody that's looking to trade late goals, this column or even this column is going to be significantly of interest, and you can start to include this data or use this data to start making some really, really well-informed decisions as to potentially what could possibly occur, especially if you're looking at a game involving two teams that actually have a very high percentage of goals scored in 81 to 85, and they're playing each other. Now, again, it's going to be no guarantee, but essentially what we're trying to do is put the odds in our favour. So the Hong Kong Jockey Club, I think, is a great find. And Rui, again, I thank you for this. And I've really been crunching through this because I think it's a great asset to have where you've got goal times down to 5-minute intervals. And they do cover quite a number of the main leagues. I mean, you're not going to get every league included, but certainly the major leagues are going to be included. So I think this is a great website. The other website I've been using is Fußball Wetpoint. It's actually German, but there's an English version of the website. And again, absolutely love this particular website because it's very, very stats heavy. And so they cover stats for, I mean, look at Denmark. Look at all the different leagues in Denmark that they actually cover stats for. So if you're somebody that likes to place trades 1, 2, 3, 4, or even 5 levels deep into a particular country where you're going down, Division 3, Division 4, Division 5, then this is a great website to utilize. So just to give you an example, if we go to Netherlands, if we go to the main top league in Holland, this is the data for the end of 2017-2018 season that ended in May for this particular league. If I click on PSV Eindhoven, you then get to see a lot of the data that's available. They've just got a huge bundle of stats. It's an analyst's delight. It's a treasure chest if you are very analytical and we're looking for alternative or additional sources of data to extract. And again, it's a free website. So again, this is a website that I use quite regularly, and they give data regarding both home and away in terms of average goals scored, and there's just a lot of data there for you to sort of sink your teeth into in terms of comparing teams that are playing together. So again, Fussball Wet Point is a good sort of analytical database to have as part of your arsenal. Another one I use is the Stats Don't Lie. Again, it's a great website because again, certainly if you're looking at, I mean, they cover a lot of different types of perspectives on football. But certainly, again, if you were looking at late goals, if I click late goals here, and they cover a good amount of countries. You know, again, what you're looking for here is a strategy that has a lot of breadth, a lot of depth, and you don't want a strategy that's necessarily just limited to certain leagues. So, I mean, they've got a lot of leagues here. If we click on a Liga in Spain, it might not be a good example to use because the league is presently, and I don't have to, yeah. Okay, so what they've got here are results for the previous season, 2017-2018. So again, what they've done here is they've defined late goals as goals scored after 75 minutes until the full-time whistle. So what you get to see is for each team, you can sort of almost work out a percentage of the amount of goals scored for home and away. You can actually see the percentage of goals that have been scored after 75 minutes. Yeah? And you can see it home and away and an overall combination view. And, you know, they also break it down. So late goals scored and late goals conceded. And so again, it's just about having insight or access to data that can help to really make the difference between making enough decisions for you to have a positive expectancy as opposed to making ill-informed decisions which actually cause your system to actually have a negative expectancy. Another website which I was looking at was Trade on Sports. This was something which I mentioned in my last webinar, and I've seen a few comments that people have said about Johnny Grossman, but you need to understand that the actual person behind Trade on Sports is actually a group of guys headed by Peter Nordstedt, and Peter's a great guy. I've seen him around in the industry for many years, and he's got a good reputation. And Trade on Sports, they have a particular package in regards to football, where they specialize in, well, I wouldn't say it's a secret because it was something that even I became aware of a number of years ago, but really didn't sort of look into it into too much detail. But I must admit, through Trade on Sports, I have started looking into it in a lot more detail. But the concept is basically that when you get early goals in a particular match, it tends to precipitate a lot of goals in a match most of the time. And that's because when an early goal is scored, especially within the first 10 minutes of a game, it's almost like it causes sort of a chain reaction where the pace of the game is already quickened. You know, whereas if you've got a game where within the first 20 minutes it's 0-0, you find that those games, one could use the argument that those types of games are slower in terms of pace because both teams are not losing, and you know, they're kind of playing at a kind of a pace where nobody's really kind of exerting strong pressure on the other team. Now, I mean, there's always going to be exceptions, especially if you've got a strong side or a strong favourite that's at home playing against a real underdog. But Trade on Sports did open my eyes to the fact that there does seem to be some interesting correlations between early goals. Now, they don't necessarily specialise in late goals. What seem to specialise is that if there's early goals in a game, then it means that there will be a high percentage of goals in the second half. But again, it's an interesting concept. I know it's got its critics, but again, I've been quite open to sort of seeing and analysing and seeing whether I can take certain principles and kind of just mould it into a form that kind of fits what I do. Because what I do, it's not so much focused on that a goal is actually going to be scored in the second half. It's actually focused on that there is going to be a goal scored after, the 83rd, 84th, 85th minute. And but again, I think Trade on Sports is something to look into, regardless of what you think about the guy who is behind this particular component of Trade on Sports. I think it's something that's useful to look into. And so these are the types of databases that I've used, and I've used them to good effects. Now, with data analysis, as I said to you, what I've been doing is cutting away some of the deadwood data, various scenarios within football games where I've kind of gone in and found that the majority of those scenarios have actually weighed my data down. So what I have found is that when I cut away the deadwood, or if I've cut away those scenarios over the course of, if I've cut away those bits of deadwood over the course of, and this is sort of a combination, and this is more looking at my back-tested data from last year. What I found was that my win rate would be more along the 60% percentile. So remember, my win rate is presently along 50%. But what I have found is that if I'm able to really kind of go 3 or 4 levels deep in terms of data mining to uncover some of the things that could be excluded and actually improve my trading performance, then what I have found is that the win rate actually stabilizes around a 60% percentile. So what I'm doing now for July is basically made some fundamental changes to the way I trade to incorporate some of these findings to see if by the end of July I notice any significant difference in terms of my win rate. Because I can tell you this, if I can get my win rate up by an extra 10% from 50 to 60, whilst maintaining a reward to risk ratio of 1.6 to 1, that would be the ultimate. That would be the ultimate for me in terms of reaching, the promised land as far as my trading's concerned. Because I'm always, trying to chip away and trying to always, there's this saying from Japan, never-ending improvement, and I'm always trying to look at ways that I can just, like a sniper who's sharpening his craft. I'm always looking at ways that I can just add a little extra 1% here or there to hopefully make a difference over long term in terms of the results. And I think I've found something, and I'll be testing that throughout the duration of July, and hopefully we'll see some significant changes in terms of the positive expectancy. So my targets for July are as follows. So I'm looking for a target where my average win rate is 60%, whilst maintaining a reward to risk of 1.6 to 1. I'm still looking to average 25 to 30 trades a week, because that gives me enough sort of occurrences to hit a particular profit line that I'm looking for. As you may well know, I'm doing this full time, so I'm not looking to earn £1,000 or £2,000 a month. I'm really looking to be earning anything from £5,000 to £10,000 a month, and so that is always my aim. Now, luckily, I've got other revenue streams on the side, so when I do have months like June, it's not too much of an issue. I can deal with it but certainly I'm not in this as a recreational sports trader to make a few quid here or there and say boom, boom, boom. I'm here to make money. I'm here to make thousands of pounds a month and hopefully scale up. So what I'm trying to do is, and in order to do that, I need to make a minimal numbers of trades per week so that I can hit, over 100, 125 trades a month, whilst ensuring that I'm not having to take massive risk on each trade in order to hit profit levels that I want to. So now number 4, I said working solely on the Bet4 platform, and that was because I was using Bet365 for June and May, mainly because of the fact that as a lot of the leagues started to retire for summer, I found that some of the potential games that I wanted to get involved with, Betfair were not doing them in play, whereas Bet365 cover virtually nearly everything that Betfair doesn't. So, but I wanted to work solely on the Betfair platform, because what I've always been trying to do in terms of my approach is simplicity. And if I can just trade on Betfair, then it just means that when I'm generating my results, I'm not having to go into 2 different systems to generate results that can be posted. And also with Bet365, we know that their pricing isn't as great as Betfair. However, I may still use Bet365 for the moment. I mean, even today, there's games in the Icelandic League which Betfair seemed to be implying that they were going to be in play, but when the game started, the games are not in play. Now the games were in play on Bet365. I haven't done any trading today because I'm trying to sort of get the rest of this presentation together to get out to you today, because there were some changes I made to the original edition. But yeah, I mean, today I would have had a day whereby I wouldn't have made any trades if it was just Betfair, because of the fact that some of those Icelandic games in Betfair were not in play. So I may use Bet365 for the time being, because of the fact that I want to still ensure that I'm getting a number of trades in each day. So I'll end again by saying this: the journey to trading, sometimes the people around you won't understand your journey, and they don't need to, because it's not for them. And again, this is a mantra which helps me to really just take on the chin whatever sort of negative comments come my way, because clearly what I'm doing isn't for some people, and but then it certainly is for some. I mean, there's a number of people who what I do resonates with them, and they share their experience with me directly by email, because obviously they don't want to start getting negative backlash from people that clearly don't understand what I'm doing. But the bottom line behind what I'm doing is it's not even really to convince anybody. It's really just to show results. And that's why I always say it doesn't really matter what I say or what you say. The barometer of truth are results, because results don't lie. And if somebody is saying it shouldn't work like that, but the results is showing that it does work like that, then it basically means that either the person who thinks it shouldn't work like that, they can either become like an ostrich and bury their head in the sand, or they can be open to change and open to the fact that there might be something that they don't necessarily know about. And a lot of the time in the game, it comes to having a humble attitude, rather than thinking just because you didn't find it that nobody else can. And we've seen that many times in the industry, where people who believe they are oracles of truth will be very, very dismissive of something which and very dismissive of it, very biased and a very warped view, without even giving the time to actually understand, without forming or applying their own sort of pre-biased judges. So it doesn't really matter for me, because even when I finish at the end of July, all that's going to happen is that I'm going to just go private and continue to do what I'm doing. Some people think I'm supposed to be selling webinars or selling systems. Well, those people are just, I would say, just damn stupid, because why would I want to get involved in selling something when I can make money without the hassle of having to deal with silly people? So for me, at the end of the day, this journey is for me, but I know that there are some people out there, and I can always tell by how people phrase their questions whether people are really genuinely seeking for truth, or whether they're just there because they've already got their prejudged, pre-biased ways of looking at things, and are simply, whatever answer you come back with, it's going to facilitate another debate, because you'll never be able to satisfy them with whatever answer you give. So I've kind of bypassed that now. I haven't got time to waste. I'm in there to make money, and money means that I need to spend more time trading rather than trying to convince people. So hopefully that's not offensive. If it's offensive, then it's probably because you're one of the people in the category that I've talked about. But if you're somebody that honestly knows where I'm coming from, I'm sure you will understand that all I'm trying to do is just provide some ideas and thoughts, because when I finish in July, I don't know if there's going to be anybody else on Twitter who is actually going to be providing the same level of information that I provide. So in terms of the website, it's www.scienceoftrading.com. You can contact me at admin@scienceoftrading.com. My Twitter handle is scienceoftrader. It's been a pleasure doing this webinar, and I will see you again in a couple of weeks' time with the final webinar 7 at the end of July. Bye-bye.